See, in this entire session for finance for non-finance professionals, the intention is to create some kind of awareness on the various aspects of finance. The prime basic aspects which I am trying to focus on is, if I look at a financial statement of a company, what should I interpret about that company? Or what are the components that are typically presented in the financial statements? So one aspect of when we talk about finance is the financial statements and understanding of the balance sheet, understanding of the profit and loss statement. There are some terms there. So how are they prepared and how do I understand that aspect? Then internal to the company, how do I plan my budgets? How do I prepare a budget? Again, what goes as a part of the budget preparation process? How do I look at predicting my revenues, predicting my expenses, and what is the output document, the final document that comes out of the budgeting and costing process? That's one second aspect which we will be focusing. And third is called as the financial management, where the focus is on, if I have pretty big projects in place, how do I evaluate, or any big investment to be made? Let's say I have to buy a big machine. How do I evaluate the worthiness of that particular machine? Is it good to buy it or not? Or how do I plan out the day-to-day capitals, which is typically called as the working capital management process? So these are the three major aspects which we are going to deal with. Wherever appropriate, we actually bring in something relating to the capital markets, where some basic stock market related stuff and all are used. So the basic understanding would be on these dimensions to start with, right? Yeah. Before we get into the entire curriculum, my name is Vamsidhar. I did my PGDM in finance and operations for in 2001 from IIM Indore, and the started this institute almost 4 years back in 2010, where the intention is to provide trainings in the areas of finance and analytics, and a lot of certification programs in the area of finance, CFA, FRM kind of certification programs. I do offer the trainings here. Apart from that, there are so many skill-based programs using MS Excel and IBM SPSS product. Various kinds of statistics trainings using these products, and exclusively for finance professionals. Again, there is a big bouquet of skill-based programs using again tools like MS Excel itself. So this is in a nutshell where we are operating in. And pretty recently, we have ventured into this actuarial sciences kind of a space, where again some kind of trainings and consultings are happening in this particular space. So till date, these are a list of our major clients for whom some training or the other in the areas of either statistics or Excel or finance. Some of these areas are taken up for these are the some of set of clients in that space. Now, coming to this course, why should someone who is not a finance person need to have an awareness about finance? Probably you must be experiencing all this, right? One, the whole scam world today is purely on the financial scams, accounting scams, manipulations of the money, right? So because of all this, when the whole business, the heart of the whole business is lying at finance, though on one side we talk about all divisions should come together to make the business successful, but at the end it is looking like success means profitability, whereas you can very well define success like employee satisfaction, which is a HR angle, or customer satisfaction, which is a marketing angle. But at the end, for a business, Success means money angle only, profitable. So which means it is coming out somewhere that at some point I need to understand the world of finance, the jargons associated with the finance. Only then the overall success is what is coming out. So, and that too because of too much of scam world around. It's better that we understand what is actually going wrong here. Only then we can correct ourselves. Even without our involvement in a lot of areas, we may think that we have done a very hard work. But on the other side, we may typically see that our entire hard work is put suppressed, and the company is sold off to someone for some kind of a deal, with or without much of an intention. So from that standpoint also, and to keep ourselves street smart, because today finance is just not an accounting game. Probably 20 years back or 30 years back, finance means mostly to do with accounts and the balance sheets and just preparing them. So it used to be more and more synonymous with the world of accounting. Today, probably these two are got completely separated. I don't see any too much of overlap between these two words. Finance is more about investing, generating profit, right? Whenever someone is saying I'm a finance person, the major focus is, okay, where am I putting my money? Not only at an individual level, even at an organization level also. The investment for an organization could be on employees. The investment could be on some machines. So where all they are investing, the intention is how they are getting it back. Right? So that is the world of finance. Whereas any transaction that is being done, I'm documenting that transaction. That goes into the world of accounting. Right? So accounting probably can be looked at very heavily in terms of bookkeeping, more like a process. Whereas using that process, how do I make a decision? How do I make an investment decision? Is what we are focusing more in the world of finance. Or based on the output that is given by the accountants, which is a balance sheet. Probably a finance person may not prepare a balance sheet. A finance person may not prepare a profit and loss statement of the company. But those are prepared typically by the accountant. But once I look at that document, what can I interpret? How do I assess the health of the company? Is it really doing good or is it in doldrums? That is some of the thing that typically should be understood by the finance person. And today, the investment space is very vast. When I say that, it's just not a stock market. It's just not buying a few bonds or FDs. Right? Today, the investment space has grown by leaps and bounds. There are something mutual fund, there are something pension fund, there are some derivatives market, commodities market, gold can be bought anywhere, real estates can be bought anywhere. So that the varying instruments that are there in the financial space are many more in number. So unless I understand the pluses and minuses, and today even a new worlds are coming up at a company's level, mergers and acquisitions, venture capitals, private equities. Again, these are all different ways of playing with money. Right? So because the avenues are so many in number, having a broad level of understanding is something that will definitely give options for us in evaluating various things. So from that standpoint also, it's better that we understand or start getting into the jargon of finance and understanding the concepts of finance, so that probably once I open up a newspaper or a financial newspaper on one single day, I should be able to understand even a decent part of it. What are being typically these guys talking about, right? So as part of this session, I was looking at these are the various spaces where we would be working on. We will be looking at some basic terms in finance, right? I'll be focusing on some basic terms of finance and what is the prime need for getting into the finance. The major thing being reading and understanding the financial statements. We'll take up one company's financial statements, right? And what all it contains. And how do I interpret it? Because this would form an important basis even if you are preparing your own budgets. Final output of every budgeting exercise also is a financial statement. But that financial statement may not be for external purpose, but maybe for your internal purpose. So, again, how do I evaluate a company's performance? And the budgeting aspects and the investment decisions. So, these are some of the spaces where we would be operating in. So, in a quick nutshell, these are the kind of chapterizations we will be looking at. So, the three major words that we are focusing on are the financial accounting part of it, which includes how do I assess the current financial position of the company, which is what is nothing but how do I assess the balance sheet of the company. Then financial performance. How did the company do in the last 1 year? This is nothing but this would be captured as a part of profit and loss statement. And we'll look at the cash flow statement of the company and what all other things I get to understand about a particular company. Because see, most of the time as a company, if I have to invest somewhere else, as an individual I may want to invest, as a company I want to take over someone else. So in these kind of situations, I need to understand a lot about the other company. And that understanding, the only major source of understanding is the financial statements of that company. See, today if I want to understand how is Infosys performing, right? I'm not an Infosys employee. I don't have any kind of access to inside of Infosys. But Infosys being a public limited company, there are so many documents which Infosys has to publish on the net regarding its performance. Some of them being the profit and loss statement, the balance sheet, the cash flow statement, they all needs to be published by Infosys. Even if you look at for your own company, you will typically find all these statements on the website of the company. There is a section called investor relations or investors kind of stuff, under which they will definitely maintain all the financial statements. So, as an external person, if I want to assess the performance of any company, I have to depend exclusively on the financial statements itself. So, the understanding of the financial statements is a key aspect in the process. Then the second part which we are looking at is from a management accounting standpoint, where the focus is internal. Financial accounting is purely from an external standpoint. How do I show it to my external people? How does the external world look at my company? Right? Something which are mandatory to be published even for the people outside the company scope. Whereas when we talk about the management accounting, it's purely internal. How do I set some target for myself? How do I set a budget for my project? How do I prepare? How do I analyze the costs? Each and every department cost, each and every product cost. How do I analyze these costs? And finally, how do I project how I should perform in the next 1 year? Probably month-wise breakup. Those are all need not be published to the external community. Those are purely from an internal standpoint. So from an internal standpoint is what is the world of management accounting. So we'll spend on these three prime areas there. And finally, the financial management aspect, where how do I plan with my long-term capital and short-term financing. Working capital is more of a short-term day-to-day operations. If I fall short of cash or I have surplus cash, how do I plan out? What kind of analysis I do to manage the working capital, and what are the various sources that are available to finance the particular business? How does the company raise capital? After it raises capital, what can it do? Today, what are the various avenues which are available for funding a particular business? These are some of the things which we would be dealing in this, right? In case you have any specific things to be included, plus or minus also, we can very well look at those aspects. So, just as a quick nutshell, as we have just talked about, accounting versus finance. I have already given you a brief description, right? The slides anyhow, I'll give them to you, so you don't need to just write down the slide. So, typically, on a broad scale, accounting is more of a bookkeeping process, whereas finance is more of a decision taking. So, accountants prepare right from the documentation of day-to-day operation. See, today I have sold something. That sale is recorded as a from whom or to whom did I sell, in what process did I sell it on cash, did I sell it on credit. This is the transaction. This transaction is noted on a day-to-day basis, and what happens, all these are collated under appropriate headings, and finally they narrow down into three financial statements. One is called as profit and loss statement, one is called as the balance sheet, and one is called as a cash flow statement. The final, all the transactions which the company has done during, let's say, 1 year period, daily you are recording them, and at the end of, let's say, 1 quarter or 1 year, you are collating them under appropriate headings. Probably today you sold one bike, tomorrow one more bike. Like that, if I take it for 1 year, you might have sold some 2000 bikes. So all that 2000 bikes, the total amount for which you have sold will come out as your total revenue. There will be one element in P&L statement called as revenue. So you will directly put it under the revenue heading. That's how a typical financial statement is prepared. Now, these are called as the final financial statements. So the day-to-day operations which are tracked, they are finally pumped into these three statements, right? And the users, different people use these statements. So if you are able to understand and analyze these three statements, there is a lot more you can interpret about any company. Probably even if you want to take your investment decisions, right? Should I buy these shares in the stock market? Which company is doing well? You have some few lakhs with you. You want to buy few shares of some company. Rather than blindly going with put here, put my money there, you can very well look at the performance of the various companies, and based on that you can take your decision on should I put it here or should I not put it here. The same thing, not only for buying the shares, probably from a bank's perspective, if they want to give a loan to a company, they will ask for financial statements, because bank will see how good is the performance of this company and what is the authenticity to that. All the financial statements need to be audited by an auditor. Chartered accountant typically is an auditor. He is the person who puts a stamp that all these financial statements are prepared as per the guidelines. Now, today most of the scams are also because of the same stamps itself, though even everything is stamped, but still there are so many accounting frauds that are going into it, and that is where you have to suspect each and every party. Even though there is an audit done, even though there is a stamping done on it, it might still be possible that everything whatever is presented, it could be a wrong or unfairly presented stuff itself. That's where the more and more you are able to dig deeper into analyzing these statements, probably you may try to identify some of these accounting mismanipulations that can very well come out, right? So different people use the financial statements only. Even the managers use it for How did we perform compared to last year? Did we grow, fall? Internal guys use the data. Investors use it. Lenders use it. Creditors, because most of the times, creditor is someone who is giving the raw materials or something on a credit basis. For a company, I purchase raw material. But most of the times, I don't pay cash to purchase the raw material. Probably I'll take a 1 month credit period. After 1 month, I pay to my vendors. It's not that the company doesn't have cash there. Even if I delay by 1 month, my cash is like rotating, right? I can use it for some other purpose. If I do an immediate cash payment, probably I'm blocking my cash. So from a company standpoint, even effective handling of a cash, it may plan out some credit sales to its customers also. It may take some credit purchases from the vendors also. So the creditors also will look at, okay, is this company solid enough? Only then we'll give a credit, right? If the company's performance is looking very much problematic, then probably they may say you have to pay us in cash itself, no credit payments, right? So even the creditors will look at it, and any other parties who want to enter into some kind of contract with the companies, either for tie-ups, joint ventures, strategic activities, anything. Let's come together. We have a share in the profits. For any kind of tie-up agreements, I will look at how this company is going to perform. Even as an employee, if I want to choose where should I join? Probably it's better for me to see, is this company really doing well or not? I mean, if I'm looking at for a safe place to work, it's better for me to look at how is the performance of the company in comparison with its competitor, right? So financial statements, especially for a public listed company, play a very major role in terms of the investors taking appropriate decisions. So getting that kind of understanding is the core thing. So all these things which a company does, these are some of the things you don't need to be a finance person to do this. Even a non-finance person today is involved. Let's say we are developing a new product, or we want to expand to a new geography. Is it worth to expand to Hyderabad, or is it worth to expand to Bombay? How do I analyze that? Right? It's just not one cost which I have to put up today. It's some benefit that I will get in future also. Right? In most of the places, let's say I am investing some few crores in Hyderabad today. My intention, I need to know in how many years I am going to break even. Right? What are the various resources that are available in Hyderabad? How much revenue I can get year 1, year 2, year 3, how much profits I can get, and within how much time I am going to cover all my costs. There is some analysis that is going into it. New product, new service, new geography, right? Or even the price. If I increase the price, what would be the impact on the total revenues? Because probably my competitor has not increased, but I have increased. So overall, I may lose to the competition my market share, which may result in I losing out on a very bad way. So all these things, they are involving some finance decision, borrowing money. See, today the borrowing is in a big way. It's a peak in terms of borrowing today. So let's say some projects, metro rail project. If I assume the cost of that project, let's say, is around 15,000 crores, almost 70% of it, minimum 10,000 crores, is through loan. Only the remaining portion is what is the real capital that is being put up by a team of L&T and various other partners. But 10,000 crores to almost is in the form of loan. So today we are talking about loans in that heavy volume. GMR airport project. Huge amount in terms of loan. So if I am taking a loan, how is my interest payment across the period? Even after paying my interest, What is my profitability? Why should I take a loan first of all? So these are some of the aspects, because today the dynamics of the way the business is changing requires us to understand from all these dimensions. So every purchasing decision, production decision, how many units should I produce? It's not that I can stock up. Today even companies on one side talk about just in time inventory system, which is nothing but don't stock up anything, right? Every stocking up requires some amount of storage cost, some amount of handling cost, some amount of spoilage could be there, lot of things could be there. But if I have some kind of a network in place, probably within no time, if I can get it ordered from my vendors and directly delivered to my customers, that's a different model altogether. So every financing decision, every business decision today is being viewed from a financial standpoint. And one more thing, the other day I was reading somewhere also, earlier the margins for operating used to be much higher, right? Earlier most of the businesses used to be labor intensive, more people working on. Probably you should also appreciate that earlier it used to be more people focused, and majority of the cost used to be a people cost. But today even in the service companies like infrastructure or IT, there is a lot of automation that is coming up. Machines have started taking over, our products have started taking over, doing the automation part, where the majority part is automated and people are required for the next part of it. So slowly things are moving more and more. Even if you look at a manufacturing kind of a world, earlier everything used to be man driven, but today machines have replaced man to a large extent. So because of that, there is a heavy focus on evaluating the cost of the machine and what benefit that it can give to me, and how many men is it equal to, in what proportion is it going to do it in a much faster way compared to a person, in how many years, because the cost is not the same as one person's salary. The cost of the machine is much higher, right? So from those dimensions, every decision that is being made in the company is being looked at from a financial decision itself. And some businesses today, they are operating in such a space where the volumes where the margins are very much narrower. If we typically look at most of these apparel industries, apparel companies, or telecom companies, they are continuously decreasing the price, half a paisa, quarter paisa, all kinds of paisas coming up, right? Which is a clear indication that everyone is playing in a very competitive market, right? Of course, there are some industries where there is still loads of profitability present, but some industries, when they are operating in a very narrow range, every decision which they are taking will have an impact on the profitability. If they are saying let's buy an automated machine, and if that automated machine is not giving the required results, no one can buy the machine again back, and it's having a huge impact on the profitability of the company. So evaluating everything from a finance dimension always is becoming a very important aspect from a company standpoint. So this is how a typical financial information is being used. We are looking at owners of the company using financial information, customers, competitors, government to decide on the taxes or to give some kind of subsidies. They use the financial information about the company. Employees, they look at the financial information thinking, because most of the companies, they link the salaries of the employees with the growth of the company. Probably they may call it variable, bonus, whatever are the names associated, but that is very much linked with the profit which the company has generated, which can be viewed from the profit and loss statement of the company. If the profit of the company has gone up, probably employee will receive a slightly higher bonus versus the other side. So employees are tracking the financial information about the company. Investment analysts, a very big space, because these are the guys who recommend which shares to be bought, in which company the investment has to be made. These are like advisors for all the investors. So these guys track very heavily because they will do all kinds of comparison. Oh, this company is much better than this. So probably go for X, put all your money in X, pull out your money from Y. These kind of suggestions are also given by investment analysts. Lenders are looking at it, managers are looking at it. So the financial information today is not restricted only to the financial people. Everyone is started looking at the financial information about the company, and that's one of the prime reasons we are looking at this. Yeah. Now, as I said, the entire day-to-day transactions of the company, they are documented and finally pooled. That pooling, to make all of us comfortable in trying to understand the pooling, how the companies have pooled each and every transaction, there are some standards that have come up. One of the most importantly used standard today across the world is called as IFRS, International Financial Reporting Standard. Earlier in India, they used to use a mechanism called GAAP, Generally Accepted Accounting Principles of India. Indian GAAP is what it used to be called as. Generally Accepted Accounting Principles of India. So the pooling, the grouping of the transactions used to happen as per this headings and formats. But today, so this gap used to be specific to each country. Indian gap, US gap, all countries gap. So what could happen is probably India could have set some kind of standard. The standards are set by the Chartered Accountants Institute of India, ICAI. So these are the guys who said in what format the clubbings have to happen, the groupings have to happen. The same way US has done in some way. So there are good number of areas where the grouping of India is slightly different from grouping of US. So today, or until a few years back, when an Indian company has to take over a US company, or a US company has to take over an Indian company, because the groupings are different, it used to take too much of a time for consolidations to happen. See, because if one company takes over the other company, the second company ceases to exist, and all the financial statement of the second should go into the first. Right? Now, to prepare that consolidated financial statement, it used to take too much of a time. The reason being, the pooling is different in different countries. And even evaluation will be different, because today, or at that point, probably if I had taken one US company's financial statement and Indian company's financial statement, okay, because the headings are different, if I see, let's say the employee costs, probably A, B, C, D items go into employee costs as per India, but only A, B, C go as employee costs as per US, and probably let's say D is being treated as other expenses here. Overall, there are four kinds of expenses: A, B, C, D. For simplicity, I am putting A, B, C, D used to be as a part of employee expenses in India, whereas only A, B, C for US. D has gone into other expenses or miscellaneous expenses. Now, when someone is looking at this versus this, probably they might be saying that US companies, the employee costs are much lesser. Because they have included only A, B, C as the employee cost. Whereas here we are including A, B, C, D, so the employee cost may look much higher. Right? So there may be a statement that may come out that the Indian companies, they spend heavily on employees compared to US companies. So statements will come out just like that without really looking at what all are going into which. Or probably if the same US company is taking over an Indian company, it will say, no, your employee costs are very high. Immediately do a layoff. Even that can come out because they may not understand that even D was included in the total employee cost. So what if you remove D and C, the total employee cost? So because of these things, the consolidation issues were becoming a big problem, and it used to take too much of a time to merge the two financial statements. And that is where a worldwide uniformity has been tried to achieve it by using this IFRS, International Financial Reporting Standards, which means across the world, all companies, they have to follow the same grouping principles. Today, almost all the public limited companies in India, all the listed companies, they are all presenting their financial statements as per IFRS only. So we don't need to bother about the Indian GAAP and all, because now there is nothing. By 2014, every company, even the smaller, it has to move towards IFRS based reporting only. So the reporting is nothing but people even talk about too much on these things. But the simple thing for us is the day-to-day transactions, they are grouped as per the headings that are typically given as a part of the IFRS mechanism. So what are the headings? If we are able to understand what goes into each one of them, right, then we can easily, hardly there will be around 30-40 groups, 30-40 kind of headings, 40-50 kind of a heading. So if we can understand those 40-50 headings, every company will have to present their statements in that 40-50 headings only, which means comparison becomes more easy. Right? Even though they have a 51st entry also, they have to put it in that 50 list itself. That is the kind of standardization that has been brought out by these reporting standards. So comparisons can become very easier. Everything, all these characteristics are being coming out in that standard that is being put. They become more and more reliable to use. They don't have too much of errors because they have detailed out. We don't need to get into each and every aspect there. What all costs they are putting into what. Because finally the statement is prepared by grouping all their day-to-day transactions into these headings, and it is the accountant who has given, or it is the chartered accountant who is the auditor who has given a stamp on it. So now what will be presenting to us as a financial statement is that 50 headings only, which are summaries of so many transactions which the company has done. And those 50, if I am able to understand very heavily, it gives me a good level of insight into the analysis of any company. So that's the characteristic here. They are creating an understandability. They are putting how much of information. Too much of information also is very difficult to process. Too little of information also is of no use. So it strikes a balance on what all needs to be presented and what all are not required to be presented, what all can be internal to your company, what all have to be mandatorily published for the external users, and what is the cost versus the benefit of each of these things. So that is the most important aspect that is going into every accounting information. So today, if we can understand the IFRS kind of a format, right, I'll put up one IFRS format document, both for profit and loss as well as the balance sheet. We are actually taking the profit and loss statement and balance sheet of one company, and we will analyze the data based on the profit and loss and the balance sheet of that company itself, right? As we just talked about, the whole world of accounting is broken down into two parts: a management accounting and a financial accounting. Sometimes we keep hearing these two things. Financial accounting is purely from an external perspective. How do I present my company's data from the external user standpoint? External user could be an investor, could be a lender, could be anyone, creditor. They are all could be some other company who is willing to take over. These are all external users of the company. So that for them, whatever is mandatory as per IFRS, only that much will be presented. So what will happen is, probably there could be a presentation on total sales volume, how many units have been sold, and what was the revenue. But there will not be any details on how many people you have given discount, how much sales you have done in the form of credit, how much sales you have done on a hard cash basis. This kind of breakup is not present. The only thing that is present could be how many units were sold in the last 1 year and what was the total revenue. So probably all you can get is what is the average price per unit, because some may be sold at a higher price, some may be sold with a discount. Overall you got that revenue, but that kind of breakup will not be there when it is presented to the external user. From an internal user standpoint, you will know, yeah, 80% of the cars, let's not give any discount. For remaining 20%, let's give some kind of a discount. So when you are making your own projections and forecasts, you have a lot of internal information, and that internal information and preparing the same kind of a statement with an access to the internal data is what we call as management accounting. You can simply differentiate. At the end, it's the financial statements that are prepared, balance sheet, profit and loss statement, and the cash flow statement. If they are prepared purely from an external user standpoint, wherein only the main information as per IFRS guideline, only that much is presented without much of a detail, that is what is the financial accounting. And that financial accounting outputs, they have a heavy regulations on them. What has to be published, what need not be published. Very much particular. So that's where if we see, they don't have too much of details. Whereas in the management accounting, you can create as much details as possible. You can go not only in terms of money, you can even do your projections in terms of units. How many units I want to produce? How many units at what percentage discount? Even at that level, you can start doing your. So financial accounting is more regulated, whereas the management accounting is not regulated at all, because management accounting is purely internal. No format. You make your own format. Whereas from a financial accounting standpoint, everything should be in the proper format. So there is a lot of regulation. Whereas when it comes to another aspect, it is published only once in a quarter or a year, financial accounting report. Management, because it is internal, you do it whenever you want. When I am saying management, it is costing and budgeting exercises. When I say financial accounting, it's more about the annual report and the quarterly reports of the companies, which are published on the website. No budget will be published on the website. No company's budget will be published on the website, but a quarterly report which is for an external audience, it is published on the website. Right? Then the financial accounting is more backward looking, which is more like historical data. What has happened in the last year? Whereas management accounting is more for the future. How much will I project for the next year? What would be the target for the next year? Right? Budget itself is for the future. So management accounting is more future oriented, whereas the financial accounting is more historical oriented. In financial accounting, only the money part is considered, not the quantities, all the other aspects. Non-monetary aspect will not be there. Whereas in the management accounting, I can even do budgets in terms of quantity, in terms of money also. Because everything, it is up to me how I want to do it. That is what is the management accounting part. And no constraints, no restrictions. But of course, both are required. Typically, if I have to put it in even more better terms, in the typical job space, financial accounting is the core aspect where a chartered accountant works through. Management accounting is a core aspect where a cost accountant will be working through. CA is a designation more towards the financial accounting aspect. ICWA is the designation which is more towards the management accounting and cost accounting kind of a prospect. Right? Yeah. So at the end, these are some of the things which I want you to be comfortable with. How do I read the financial reports and interpret them? How does the company make a financial plan and a budget? And how the typical investment decisions are made, along with how the financing is being done at various levels. All right. So, as I said, we have to talk about the three financial statements. This is where we'll get into the understanding of the three financial statements. What are they containing? When I say profit and loss statement, it is nothing but during this particular year, what are the revenues and what are the expenses of the company. It's a consolidation of what is the net profit or loss the company has generated during this year. Let's say if I am taking the year from April 1st to March 31st, that is typically called as a financial year. Most of the countries, April 1st to March 31st is what is called as a financial year. So, during that 1 year period, what are the various revenues the company has got? What are the expenses that are incurred by the company? And net, what was the profit or loss for that particular year? It does not talk anything before that. It does not talk anything after that. It's only from this date to this date. Revenues, key items are revenues, expenses, profit and loss. That is what is a typical profit and loss statement. So, the usage of that is the performance. How did the company perform in that 1 year? During that year, did its revenues, is it revenues more than the expenses or expenses more than the revenue? On the net, did it generate a profit or did it generate a loss? That is what is the typical intention of looking at the profit and loss statement of the company. Then, let's say a company has started its business. Okay, the simpler example I'll go with. Let's say today I have started the business with 1 crore. I have put in some capital of 1 crore and started some business. Using that 1 crore, I might have purchased a lot of things. I might have purchased some raw materials. I might have purchased some machines, whatever. I have purchased some of them. And based on that, I started my operation. Now, whatever the sellings I have done during the year, whatever the customers, the selling I have done during that year, and whatever the operating expenses I had during that year, that entire thing goes as a part of P&L statement. But at the end of the year, I am left still with something. Right? At the beginning of year, I was left with something. Capital was there in my hand. Or probably at the end of the year, I have some machines. which may not be fully scrapped, but they have some value still. I must be having some bank loan outstanding. At the end of 1 year, the bank loan is not fully paid off, right? There must be something outstanding at the end of the year. All those outstandings, whatever are there, outstanding is either I have to get the benefit from them or I have to give the benefit to someone else. Those are the outstandings. As I said, I did not sell all my bikes because I am talking about the year means April 1st to March 31st, right? As on March 31st, I might not have sold all the bikes. I might have manufactured them, but still there are some lying in my godown, not yet sold, right? Or I might have given some kind of credit to someone. They did not give me the cash till 31st. See, if I have sold it on 25th March on credit, saying you give me in 15 days. So he has not yet given to me. Even that is possible, right? Or I might be having having some loan. I have taken a loan, but did not pay back to the bank. Or I have few machines with me. Or I have purchased a software to run my business operations, which can run for a couple of more years. So I have done a one-time investment on that. So what will happen is at the end of every year, the business is not zero. Even though I am talking about some revenues, some expenses in that particular year, at the end of the year, the business is still not zero, right? So whatever are outstanding, they will be entered into a balance sheet. Balance sheet. Whatever is the company balance that is there, it's not just the cash. Anything that is convertible to monetary, like I have 100 bikes which are yet to be sold, right? If it sells, it will get money out of it. So that is something that is outstanding that the company is having, right? If it sells that, it will get money. Negative or positive. Outstanding that I should receive cash. Outstanding that I should pay cash. Payables and receivables. So outstanding that I have to receive cash, they are all classified under what are called as assets. Whatever will give me the benefit in future. Benefit in terms, whatever I can convert them into cash in future. Cash or some kind of a benefit. If I have bikes, if I sell them off, I'll get some money out of it. I have some debtors with me, like someone whom I have sold the goods on credit, they still did not give me the money. So if they give, I will get some cash, right? Or sometimes something like I have a machine with me. Probably if I sell off the machine, I'll get something out of it. Or even if I don't sell off, if I use it to produce some of my goods, they are still going to fetch me something, which is like they are beneficial to me in the next year. I will get the benefit from them in the next year. Still, they are not like when I have purchased a vehicle, right? I have purchased a vehicle. I did not purchase the vehicle with an intention of using it only for this year, right? This vehicle may be used for, let's say, for 5 years, right? Probably I may say after I use it for 1 year, 80% of the vehicle is still fine, right? Probably let's say if I simply assume the vehicle will run for 1 lakh kilometers, simple, right? After 1 year, I have completed only 20,000 kilometers, which means at the end of 1 year, there is still some value associated with that vehicle. right? Probably it can still service 80,000 more kilometers. There is still some value that is associated with the vehicle. So I'm going to still get some more benefit out of that investment. Similarly, bikes, they still will give me the benefit in the next year, because the financial statements are prepared keeping in mind 1 year. During this year, whatever you have sold, whatever you have got, you are putting it in the P&L statement. At the end of the year, whatever you are left with, are left with in terms of receiving or in terms of paying, whatever is outstanding in terms of receiving or paying is going into the balance sheet. Once we take up that example, we can clearly look at the differentiation. So balance sheet always contains nothing about the year at the end of the year. At a particular point in time, what is that I have, what is that I will get, what is that I will have to pay in the next year. Let's say I have taken some goods on credit on 25th March, but I have deadline until 1st of May. So as on 31st March, it looks as if I did not pay that. Outstanding from my side to pay to the other party. Right? So whatever is outstanding on a particular date, let's say I have taken a loan for 5 years. I may pay only some portion of the principal. If it is an EMI kind of a payment, I'll not clear off the loan within the next 1 year. It will take 5 years. So at the end of 1 year, there is still something that is outstanding from my side to be payable to someone else. So whatever is yet to be received for me, I call them as assets. Whatever is yet to be paid from my side, I call them as liabilities. So the balance sheet is nothing but a combination of these assets and liabilities. So simply put, P&L statement talks about the transactions for the year, only for the year, nothing before, nothing after. From this date to this date, whatever sold, whatever obtained, profit, loss for that year. But at the end of the year, on 31st March, check out all your balances. You may be having some cash in the bank balance, right? Or you may be having some inventory in your godown. Some bikes could be there in the godown, or something that you need to receive from your customers to whom you have sold on credit, or some machines could be there, or some buildings, some vehicles, some software you might have purchased which will give the benefit even in the next year. It's not a scrap, right? So all these things, or you might have done some investments. You might have bought some bonds which will mature after 5 years or something, which will give the benefits after the financial year, not as on 31st March, but you will get some benefit out of it even after the 31st March. Similarly, the loan, you will pay only after 31st March, sometime in the later, after 4 years, 5 years, but not done during that 1 year period. Whatever are outstanding, we will treat them as a part of the liabilities and assets. So that together is what is going into the balance sheet. So if I look at also what I have done during the year, what is remaining. If I put these two things together, that's the whole operations of the company. What did I start with is the balance sheet last year. What did I start with is the balance sheet at the beginning of the year. What was my position at the beginning of the year, which is on 1st April, what is my position? The balance sheet. What did I do during this year? From 1st April to 31st March, P&L statement. What is left as on 31st March? Another balance sheet. Whatever is still left, these two are actually prepared separately. Of course, P&L statement, based on the P&L statement, take the last year's balance sheet and the P&L statement of this year. These two will give you the balance sheet for the next. I'll give a better example. Let's say first year, the only thing I have is a capital. Is a capital of 10 crores, 1 crore. Right? So in the balance sheet, what will be shown is the assets are a cash of 1 crore. I have 1 crore in my bank account. So I have 1 crore as a cash in my account. Now I'm starting my business. Probably I have purchased some machines, a couple of vehicles, and some raw materials to typically produce some bikes. Right? So there are some machine purchases that are done. There are some raw material purchases that are done. So I have produced some bikes. So I might have sold some of them. Whatever I have sold and whatever was the cost that is incurred to sell those bikes, to produce those bikes, they are shown in my P&L statement. But at the end, whatever I am left with, that's again a separate thing, right? At the end, okay, I have sold 50 bikes during the year. How many bikes are still left? I don't know, right? I have to check. I have started with some capital. I have purchased so many things, not just the raw materials. I have put something in my employees. I have paid my employees. I have paid something for rents. There are so many expenses that I have incurred. So, I have sold 50 bikes during the year. I don't know how many are left. What number of bikes are left? So, in the earlier year balance sheet, bikes left are 0 because I did not produce any. Right? But this year balance sheet, let's say 20 bikes are lying in my godown, still to be dispatched. I'll say 20 bikes and whatever was the worth of those bikes, that I will take into the balance sheet amount for this year. So which means I have bikes worth this much in the balance sheet. Purchase, I'll come to that. The purchase of the machine, there is an aspect called depreciation. We'll discuss about it. But in a nutshell, the purchase of the machine is shown in the balance sheet itself, because machine is something that is not for this year. Only a portion of the machine investment is for this year. Let's say I have purchased a vehicle, right? 5 years is the life of the vehicle. So which means for 1 year, it's only 20% of the cost of the vehicle. That is the expense for this year. Though I might have paid 10 lakhs to purchase that vehicle, but the usage wise, it's only 20% of the vehicle, which means that 10 lakhs I have invested in simple crude sense, that 10 lakhs I have invested for 5-year period. So per year, it's just 2 lakhs. So when I am preparing the expenses for this year, corresponding to that machine, I'll put only 2 lakhs. I'll not put 10 lakhs. Right? We will look at it. Once we take up the example, things become very clear. Right? So, which means, in that same example, 8 lakhs worth of it is still existing. So, which means that 8 lakhs I will put in the balance sheet as an asset. 2 lakhs I will put in the P&L statement as an expense. Getting the difference? Though I have spent 10 lakhs, cash wise, I have paid 10 lakhs to the other party, to my seller. But because it is having a usage for more than 1 year, we call those kind of purchases as capital purchases. They are like, they will give me a benefit for a longer period. Whichever are those capital purchases, we will do a proportionate cost for that and try to allocate for the year. Whatever is the balance that is left, I'll say that is my asset. So what happens at the end of the year? Like this, so many are there. Machines, vehicles, software. I might have spent some 50 lakhs on purchasing one software. But that 50 lakhs, I may be using, let's say that license is for 5 years. If that license of it is for 5 years, better instead of showing 50 lakhs as an expense for this year, I can show 10 lakhs as an expense for 5 years. Because I'll use it for a 5-year period. So that is what is actually the concept of depreciation. Once we get into it, I'll show you that part. Right? Okay. So these two put together, a balance sheet and a P&L statement, will talk about the total business. What has happened during the year? What is left with the company at the end of the year? But the third statement, which is called as the cash flow statement, is also very much essential, because this talks about the real movement of cash. In that same earlier example, what did I say? I gave 10 lakhs rupees to my seller of the vehicle, right? But in my expenses, I'm showing only 2 lakhs, right? This is not an accounting manipulation or anything. This is as per the rules, because the rule simply says if you are using any particular item for a longer period, you can spread the cost of that item. Otherwise, what happens if you have made a huge purchase this year? Suddenly it shows your company is in a loss. Your expenses are very high. It does not indicate anything about the performance of the company, because performance is more to do with sometimes I may have to wait for 5 years to actually realize my big benefits. So this year, once I have invested heavily on the machine, if my profit and loss statement shows I am at a big loss, probably people will develop negative opinion about the performance of the company. So to avoid all these things, it is a first important thing in the preparation of the financial statements. If any purchase has been made by the company which has a benefit of more than 1 year, you spread it in the proportion. You spread the cost in the proportion. So because of this here, what has happened? 10 lakhs, though you have in cash, you have paid to your vendor. You are not showing the entire 10 lakhs as your expense, but you are showing only 2 lakhs as your expense for this year. So it may so happen that your profit may be higher, but in reality, you don't have cash with you. Where is the cash? Cash wise, you have paid 10 lakhs. Right? There might be a cash shortage that may come up, because the profit and loss statement may still show that you are profitable because you are putting only 2 lakhs as the expense. So if your revenue, let's say, is 8 lakhs, if your revenue is 8 lakhs, the expense will be shown as 2 lakhs and the final profit will be shown that you are profitable by 6 lakhs this year. But when you look out for your pockets of 6 lakhs money, that is not available. Right? Cash wise, you have paid 10 lakhs to the other party. So you are falling short of cash. So, but all my vendors require cash. So, cash position is also a very important aspect. It may not be directly linked with profit. Cash and profit are not the same thing here. Right? Cash need not translate the same. Profit need not translate the same to profit or same to cash or vice versa. You have seen this as an example. In the statement, they'll show 2 lakhs as the expense. So when you look at the final 6 lakhs as a profit, your pocket may not show 6 lakhs at all, because you have paid 10 lakhs to the other party. So there is no way your 6 lakhs could be there either in the bank or anywhere. So what are we talking of here? The profit and loss statement is a purely a notional statement, which is purely based on the accounting norms and standards. Whereas the cash flow statement is the reality. Hard cash. Hard cash, how much is there? How much am I short of? Right? But the cash flow statement can be fluctuating quite drastically. Because the moment I make a big purchase, even though it has a benefit for 10 years, it will show I have a big negative cash. That negative cash means because everyone requires the cash only to be paid, I have to borrow in the middle. So the cash management is a very important aspect. That is what we deal with in the working capital management aspect. Because cash, though profit is what investors will look at. Okay, this company is able to generate profit. Profit from that accounting notional standpoint itself. But if you are making your budgets, profit you will still make the same way as per the accounting standards itself. But it may so happen that after you make your budget for 2 months or 3 months, your cash is going negative, which means you may have to borrow for 2-3 months. Because see, without cash you cannot do anything. Though your profit and loss statement is more and more notional, more and more as per the accounting norms, cash is a reality. So what we can actually do is, by combining the profit and loss statement and the balance sheet, the cash flow statement can be generated. This is like a derived statement, because profit and loss and balance sheet are the two key pillars which will explain the whole business. Using those two, I can prepare a cash flow statement. We'll look at that aspect also, how easy to prepare that. At a very high level, how quickly I can make a cash flow statement to check out for the status of cash in the company. And only when I look at all three, I can talk about the big picture about the company. And the different types of people look at different attributes in this. Lenders will see some aspects of P&L statement. Banks, they see some aspect of the P&L statement, some aspect of the balance sheet. Okay, what all they can look at in the balance sheet? How much loan is outstanding still for this company? See, they have come to me for a new loan. How much of it is still outstanding? How much capital did they put in? See, they look at the backup options, right? What if this guy cannot pay back this loan? What all other assets he have, so that I can take those assets? Right? Does he have some big building in place? If that company is having some big building, probably can we take that as a collateral? Right? So these are some of the things which every interested party with the company will be typically looking at. Right? If you are an investor, okay, how good are the profits of the company growing every year? Because when the company generates a profit only, it will give some dividends. Dividends are nothing but a share of the profits. When a company is giving some kind of a dividend, it means nothing. See, when you do a business, whatever the profit that comes, it's your money. Whenever you put in some capital, you get some profit in the business, that profit belongs to you. So like that, anyone who is buying the share of a company, it means he is actually putting some small capital in that business. So whatever the profit the company has generated, in the proportion of his investment, he will get that amount. So if the company is generating profit, he will also get his share. So how is the profitability of the company growing? If it is growing more and more, there is a good chance that he will get more and more in the form of dividend. But if the profitability is falling last year to this year to next year, if it is showing a kind of a fall, then probably as an investor you don't want to invest in that company, because you may not get much in the form of dividend. So an investor may look at the profitability of the company. So a bank may look at how much debt is already there, or what are the other things which we can take as collateral. How much debt is already being taken by the company. All these things, because the more and more debt already exists and you are approaching for another extra loan, the chances of defaulting are much higher. Right? So sometimes, just like in our individual case, if a bank has to give a loan, they ask us for our salary statement. Right? Any kind of a loan, Why salary statement? It's a source of consistent income, right? Even if I say I'll show you one more house, I'll keep the house as a collateral. They don't prefer that too much. On the other side, they look at your salary statement. How consistent is your earning? What is your capacity to pay off interest and principal, EMI at regular interval? Same thing when I take it into the business parlance. How consistent are the operations of the company? Right? It's like the salary for the company. Profit is nothing but the salary of the company. So how consistent is the profitability of the company? Because only out of that profit, the interest would be paid. Only out of your salary, the interest and principal are paid. Here also, only out of the business profit, the interest to the bank and all would be paid. So they will look at how good is your P&L statement. Right? So that's where we should be comfortable in trying to understand what all aspects are there into these things, so that we can do a kind of a projection for the performance of the future, and based on that take our investment decisions about the company. Right?